This token over here, you heard about this meme token here. Meme this, meme that. Shut up! You're standing at the precipice of a financial revolution. Forget what you think you know about traditional markets. What's unfolding with crypto and blockchain right now isn't just a new asset class. It's a fundamental rewiring of global finance, ownership, and even how we interact. And if you're not paying attention, you're risking getting left behind. Let's demystify crypto. At its heart, a cryptocurrency is a unique digital unit of value secured by cryptography and managed on a blockchain. Think of a blockchain as a transparent, immutable ledger, a shared, decentralized database visible to everyone, but controlled by no single entity. This is why it's so powerful. No central bank, no government, no corporation can unilaterally change its rules or censor transactions. When you buy a cryptocurrency, you're acquiring a digital asset. It's a unique digital signature representing ownership on the blockchain. Unlike traditional stocks, which rely on a company's centralized record keeping. Now, thousands of these digital assets exist, but they primarily fall into two categories: coins and tokens. Coins are native to their blockchain. They're native to their own blockchain, like Bitcoin, BTC on the Bitcoin blockchain, or Ethereum on the Ethereum blockchain. They're often used to pay network fees and act as the foundational fuel for their respective ecosystems. They're complex and expensive to create, hence why there are fewer of them. Then there are tokens. These are digital assets built on top of existing blockchains. Think of them like applications or utilities running on a smartphone, the blockchain. They're easier to create and serve specific functions within decentralized applications. Most of the 100x opportunities you hear about, and frankly, a lot of the worthless pumps, are in the token space. The value proposition isn't always about being a currency. So how do you sort the signal from the noise? You need to understand how crypto projects generate and sustain value. It starts with tokenomics, the economic design of a cryptocurrency. This tells you how tokens are distributed, how new ones are created, and how they're used within the ecosystem. Key metrics to watch are market cap, the current price multiplied by the circulating supply. This is the true size of a project. Total supply, the maximum number of coins that will ever exist, if capped. And fully diluted value, FDV, the market cap if all possible coins were in circulation. Why is this vital? Because if a project has a low circulating supply, but a massive total supply, it means a lot of future tokens can dilute your holdings, even if the market cap stays the same. Your primary research hubs for these metrics are CoinMarketCap and CoinGecko. They provide comprehensive data, white papers, team info, and even investing schedules, which detail when new tokens enter circulation. Another powerful indicator of real-world adoption is total value locked, or TVL, typically found on sites like DeFi Llama. TVL measures the amount of crypto assets locked within a specific blockchain or decentralized application. High TVL indicates strong user engagement and trust. Ultimately, value comes from solving real problems. Always ask, what practical problem does this actually solve? Now let's talk about the money. Making profit in crypto primarily involves acquiring an asset at one price and selling it for a higher one. This can be through investing, holding for over a year, or trading. Long-term investing typically incurs lower capital gains taxes, which is a critical factor for financial planning. For long-term investors, two simple yet powerful indicators can guide your Bitcoin buys and sells. First, the Bitcoin mining cost. Historically, when Bitcoin's price approaches or dips below its mining cost, it often signaled a strong accumulation zone. Miners can't sustainably operate at a loss, creating a natural floor. For finding potential market tops and strategic exits, consider the Bitcoin terminal price. It's a simple, high-level tool to gauge when the market might be overheated. Time to sell. By rinsing and repeating this strategy, buying near the mining cost and considering selling at the terminal price, you can significantly compound your portfolio over market cycles. Whether you're investing or trading, remember, market timing is incredibly difficult. Time in the market often beats timing in the market. Now that you know how to assess and potentially earn, let's talk about secure management. This is critical. Your first priority, security. Never ever share your private keys or seed phrases. Think of them as the master keys to your entire crypto fortune. Use strong, unique passwords and enable two-factor authentication on all exchanges. For significant holdings and long-term storage, a hardware wallet like a ledger is your best friend. This offers self-custody. You hold the keys, making your assets virtually hack-proof because they're rarely online. Use exchanges like Coinbase for easier access to funds you're actively trading, or you might want to buy or sell more frequently. And finally, stay organized. It's easy to lose track in crypto. Use portfolio trackers like the CoinMarketCap portfolio feature. You can manually input your buys and sells, see your profit loss at a glance, and track holdings across different wallets and exchanges. This market is exhilarating, complex, and full of incredible opportunity. This guide is your starting point. It's designed to give you the foundational knowledge to navigate the noise and build your own path. Remember this: investigate truth on your own terms. Ladies and gentlemen, it's your man Brando, and I'm signing off. Peace!